Welcome to The Explainer. So, let's talk about something every partnership has to deal with eventually. What happens to the money when a partner decides to leave? We're going to break down all the essential accounting steps to make sure it's a clean and fair exit for everyone.
This is a huge moment for any business, right? It kicks off a whole chain of financial steps. The goal, make sure everything's fair for the person leaving, and just as important, that the business can keep running smoothly. It's way more than a simple handshake. It's a delicate financial process that you've got to get right.
So here's how we're going to tackle this puzzle. We'll break it down into 5 clear steps. First, we'll look at the immediate ripple effects. Then, we'll see how the ownership map gets redrawn. After that, we'll get into valuing those tricky intangibles, like goodwill. Then, we'll balance the old books. And finally, we'll get to the actual final handshake, the payout.
All right, let's dive right in. Look, a partner leaving isn't just a simple goodbye. It's a complete financial reset for the firm. Legally and financially, the old partnership is dissolved. Poof, gone. And a brand new one has to be formed with whoever is left. The whole point of this entire process is to solve one big problem. How do you fairly figure out what the departing partner is owed and then pay them? It's a real balancing act. You have to give them what's rightfully theirs, but you can't let it drain the business of the cash it needs to survive. Okay, first things first, we've got to figure out the new ownership map. So when a partner leaves, what happens to their slice of the ownership pie? Well, it doesn't just vanish. It actually gets absorbed by the partners who are sticking around. And for that, we use a key concept called the gaining ratio. This is super important. The gaining ratio is basically the rule book that tells us exactly how the departing partner's share of ownership and, crucially, future profits gets divided up among the remaining partners. Let's make this real with a quick example. Okay, look here. We've got partners A, B, and C, and they share profits 3 to 2 to 1. Now, say A decides to retire. Their 3 part of that ratio is now out of the picture. So, what are we left with? Well, we're left with B and C's original relationship, which was 2 to 1. And that's it. That becomes their new profit-sharing ratio. In a lot of cases, it's really that simple. Okay, but a partner's share isn't just about the obvious stuff, right? It's not just the money in the bank or the furniture. We have to account for the things you can't see, but are sometimes the most valuable assets of all. I'm talking about the company's good name, its reputation, that loyal customer base it's built over years. In the world of accounting, we wrap all of that up into one powerful idea: goodwill. So how do we handle goodwill? There's a really specific 2-step dance we have to do. First, if there's any goodwill already listed on the balance sheet, we have to write it off. We basically wipe the slate clean, and that affects all of the original partners. Then, step 2, the remaining partners, the gaining partners, compensate the one who's leaving for their share of the firm's real current goodwill value. And this is so important because it's how they get paid for helping to build that brand and reputation. All right, now we're getting into the real nuts and bolts of the accounting. We need to basically take a snapshot of the business's true financial health on the exact day the partner walks out the door. It's all about making sure the past is settled up fairly before the new, smaller partnership can move on. So what does that mean? Well, for starters, it means we have to distribute any profits that have been saved up over the years. Things like a general reserve or a reserve fund. Think of it as the company's rainy day fund. That money gets divided up among all the original partners, including the one who's leaving, based on their old profit-sharing deal. And hey, fairness works both ways. The exact same rule applies to any accumulated losses. If there's a negative P&L balance, or maybe some big expenses that were paid for in advance, like a massive ad campaign, those get shared too. Yep, everyone has to take their share of the hit, and that amount comes right out of their capital account. Now, here's a point that is absolutely crucial for fairness. All the assets and liabilities have to be revalued to what they're worth today. So why do we do this? Simple. That office building you bought a decade ago, it's probably worth a heck of a lot more now. That increase in value didn't just magically appear. It grew while the departing partner was still there. So that gain, or any potential loss, belongs to the old partnership and has to be shared by everyone. This leads to a really common problem, right? What do you do about the profits earned between the last time you officially close the books and the day the partner leaves? If someone leaves in, say, June, you can't just ignore the first half of the year. You have to estimate their share. And as this shows, there are 2 common ways to do it. You can either base it on how much time has passed, or you can base it on the sales the company made during that time. Okay, and here's where it gets really interesting. The way you actually account for these in-between profits depends entirely on what the remaining partners do next. If they just keep their old profit-sharing relationship, you use a simple temporary account, a P&L suspense account, to park the money. But if they decide to create a totally new ratio for themselves, the accounting changes. It gets a bit more direct, and you have to adjust each partner's capital account right away.
So, after all of that, the goodwill, the revaluing of assets, splitting up the reserves, calculating those interim profits, whew, we finally have it. We have the final number, the grand total that's owed to the partner who's leaving. Now for the last piece of the puzzle. How do we actually pay them?
Really, the business has two main options here. Option one, pay them the whole amount at once. It's a clean break, but man, it can really hurt the company's cash reserves. Option two, turn that final amount into a loan. This is great for the company's immediate cash flow, but it means the ex-partner is now technically a lender to the business, which is a whole new relationship.
And if they go the loan route, it's usually paid back in installments over time. This timeline gives you a good idea of how it works. Each year, the firm pays back a chunk of the loan, plus interest on whatever is still owed, and they just keep doing that year after year until the debt is completely paid off.
So, what's the big takeaway here? It's that this whole process isn't and shouldn't be some random, messy negotiation. It's a structured, step-by-step procedure. And it's designed that way for a very good reason, to protect everyone involved. The person leaving gets their fair share, and the business that's left behind can move forward with confidence and financial stability. And that brings me to one last, really crucial thought, especially for any of you out there who are in a partnership right now. The easiest, cleanest, and least painful partner exits are always the ones you prepare for ahead of time. Having all of this stuff, how you'll value the business, how you'll handle goodwill, how the final payout will work, spelled out clearly in your partnership agreement from day one, that is the absolute best way to handle what is eventually inevitable.